Welcome to 2022, where the news seems to focus again on rising rates, whether it's about COVID infection rates or interest rates or inflation rates. Seems like rates, and they're rising, are what's in the news. The markets seem to be most concerned about interest rates, it seems, and we'll look at why that might be the case and what might be in store for investors for the remainder of 2022. I'm Kent Kramer. I'm the Chief Investment Officer at Foster Group, and this is our bi-monthly look at what's been happening in markets and the economy, and thinking about what investors may need to know as a result. So equity markets got off to a bit of a rocky start in 2022. US small companies and large companies both had negative returns in the first week. The US did see a bit of a difference between value and growth stocks. And if you look at the brown line on the chart and the green line, the dark green line, those represent value stocks in the small and large marketplace. The regular part of the stock market, kind of the whole market, if you look at the orange line and the light green line, they were more negative than the value side. So value stocks started off a little bit better, which had not been the case both in 2021 or 2020. Foreign stocks ended the week mostly unchanged, and bonds as a whole had a down week as well to start the year because interest rates started to rise. And as we'll see in a bit, bond prices and interest rates are inversely related. So when rates rise, bond prices tend to fall. For 2021, most equity asset classes, US large companies, small companies, companies from developed foreign markets, they all saw good growth. Small companies, which had a great first half, saw a little more volatility in the second half, and some of their stock prices ultimately fell off a bit. Only emerging markets of the major equity asset classes saw a decline for the year. The bond market was also down slightly for the year as interest rates rose, especially as those interest rates rose early in the year. Bonds had come off an unusually good year in 2020, so it wasn't entirely unexpected for them to retreat a little bit in 21. So what influenced investors and ultimately markets in 2021? Well, if you look at this chart, there was a whole lot of news, and this doesn't cover all of it, but it covers a lot of it. Everything from rioters storming the Capitol on January 6th to an impeachment proceeding to meme stocks like GameStop, to Delta and now Omicron, vaccination status, unemployment, infrastructure bills, rising inflation. We could go on, right? You can look at this list. The news drumbeat just goes on day after day, and investors are always left to sort out what, if anything, they should be doing as a result of that news. They're trying to make sense of so much information. Dan Kahneman said, "The world is incomprehensible. It's not the fault of the pundits, it's the fault of the world. It's just too complicated to predict." He said, "It's too complicated and luck plays an enormously important role." Two things we're sure to hear a lot about this year are inflation and interest rates. Inflation because it's rising, and interest rates because the Fed has indicated that they'll likely try to raise rates. Inflation year over year through November was up 6.88% broadly measured. Energy costs in the same time period were up over 30%. Historically, the Federal Reserve has targeted a healthy inflation rate of between 2 and 3%. And when inflation looks like it might move above or stay higher than that healthy rate, the Fed becomes less accommodative or less stimulative to the economy, and they raise rates, and they do things that kind of tighten down the economy and try to slow down growth. They do this, slowing down the economy, so they can keep inflation from running up to even higher numbers than the 6.8 it is right now. What they're really concerned about is not letting inflation go back to where it was in the 70s and the 1980s, when it was well into double digits. The thing about inflation going up and rising interest rates is they can have a negative effect on stock markets. So let's talk about why and what the Fed is contemplating here going forward. Before we do that, though, I want to give you a little bit of background in something that I'm going to call Bondspeak, because a lot of times when you hear people talk about bond markets and interest rates, there's some jargon that gets thrown around, and it can be confusing or put you off a little bit if you don't know what's being said. So let's talk about a basis point or a BIP. 1 basis point or a single BIP equals 1/100th of 1 full percentage point. So there are 100 basis points in 1 full percentage point. And the example of how this comes across, if you hear a news story or read it, it might say the Fed plans on raising rates 25 basis points in 2022. That would indicate that they will raise the rate by 25 100ths of 1 full percent. Now, what is the Fed kind of contemplating for 2022? Well, in terms of interest rates, here's the news that they've released. The federal funds rate is the target rate set by the Federal Reserve at which commercial banks borrow and lend their excess reserves from each other overnight. So it's a rate that has an influence on the overall bond market, but it's just one single rate, and it's really the only rate that the Federal Reserve directly controls. But by raising this short-term rate, they're attempting to influence other rates in the marketplace. So what are they saying about rates this year? Well, the Federal Reserve's Open Market Committee is the key group of bond or Fed board governors. And each of those governors has kind of in their mind what they think rates should be given the current set of economic circumstances. At the end of each Federal Reserve meeting or meeting of the Federal Reserve Open Market Committee, they release some notes that include something called the dot plot. And that's what we're looking at here is the FOMC dot plot, where the Board of Governors are releasing their ideas of where they think rates should be. You can see right now in 2021, all the dots indicating each Fed governor says, yeah, we think right now they should be at 0 to 25 basis points, very, very low for that interbank lending rate. But by the end of 2022, you can see that as a whole, the group thinks rates should be higher. In other words, they want to raise that Federal Reserve rate and try and influence other rates in the economy to go higher as well. They're not all in full agreement as to what that rate should be, but the idea here is it should be higher. And if you look at kind of the average, it looks as though rates should be 75 basis points to 1 full percentage point higher in the minds of the Federal Reserve Open Market Committee by the end of 2022. So while they can raise those short-term rate, the one rate they control, what they can't do is control the market as a whole. The rest of the bond market is a function of buyers and sellers, people like you and me, who are choosing to buy government bonds or corporate bonds. And what we choose to pay for the bond is kind of creates the interest rate on the bond. It's an auction process. Now, what's going on in these charts that we're looking at here are the impact of what might happen if rates rise. Again, the Fed only controls the Fed funds rate, that overnight rate. But if rates rise generally, again, it has the impact of causing other bond prices to decline. And the chart on the right shows that. It shows the impact of a 1% rise in interest rates at different kinds of bonds. The basic story here is if interest rates rise, the price of bonds existing in the market will go down. No, that makes perfect sense, because if you own a bond that's yielding today 2%, and tomorrow a new bond comes out, same maturity, yielding 3%, people aren't going to pay as much for your 2% bond as they're willing to pay for the bond now yielding 3%. So again, the Fed gets to control that one short-term rate, but the investors in the market get to control the other rates. Now, what about the chart on the left? Well, the graph on the left is something called a yield curve, and it's showing the relationship of various treasury bonds on 3 different dates. A yield curve simply is a kind of a curve of the relationship between bonds of different maturities and the associated interest rate for each maturity. We'll see that here in just a second. These 3 curves represent that relationship between rates and length to maturity or duration on 3 different dates. Back on September 30th, you can see kind of the light blue line. And then on 12/31 is that yield curve is represented by the dark blue line. Now, the interesting thing about those 2 lines is why they're different. The dark blue line represents the yield curve after the Federal Reserve announcement that they intended to raise interest rate. That dot plot came out. So what happened? At the left end of the curve, you see the dark blue line has shifted up, because people in the marketplace now know, hey, the Federal Reserve is intending on raising rates. So we're going to go ahead in anticipation of that, and we're going to bid up those rates on existing bonds that are in place today. The other interesting thing to note is at the right end of the curve, out here in the longer duration bond, the 30-year Treasury, instead of the rates going up out there, they actually went down. So again, this is just kind of reiterating the idea that while the Federal Reserve has a great deal of influence on rates at the short end of the curve, back there in the 3-month and 1-year rate, where the orange circle on the left is, they don't have as much direct influence out here on long-term rates. That's what makes things so hard to predict when it comes to what's going to happen, or so hard to forecast when it comes to what's going to happen with interest rates. So the thing to remember, I think, when we think about bonds in your portfolio is what's the main purpose of those bonds? Well, they're primarily risk management tools. They're sources of liquidity and spendable dollars. They're there so if the equity market really does badly, the bonds will have value for you. They tend to hold their value and be less volatile than equities. The interesting thing looking ahead is if equities go down, and at some point equity prices will go down, oftentimes what happens is people sell equities and they buy bonds, and that demand for additional bonds actually causes the price of those bonds to go up and interest rates to go down. Again, it doesn't seem like that's where we're going right now with kind of all this talk about rising rates. But as Jason Zweig says, most investors are treating the forecast, this idea of Fed raising rates, as though it's a foregone conclusion. And he just says, hey, look, in the past, while the Fed might release their guidance, lots of things can happen along the way that would cause them to change what they actually do. So investors would be wise to not try to position their entire portfolio or take action on something that might happen in 2022, but it might not, or it might happen in a different way or to a different magnitude. The media, the financial media and otherwise, they love to have things to talk about. So we're going to hear a lot about forecasts throughout the year and trying to understand what's going on. But one thing to remember, according to Zweig, his article here titled The Best Investment for This Coming Year, he would say the best investment is in discipline. In other words, the ability for investors to kind of keep their focus on their long-term financial plan and not let the short-term noise cause them to commit to doing something that they might later regret. You know, with everything going on in the world today, you might be wondering if forecasts are worth paying attention to at all and whether the outlook for 2022 indicates that some changes are needed for your portfolio or financial plan. The Foster Group Director of Advisor Success, Jason Brown, and I are going to be discussing the idea of forecasts and how to effectively respond to forecasts and the slew of information that comes at us every day. We're going to talk about this next Thursday, January 20th. We'd love to have you join us for that. There's some sign-up information on our website, and you can see how to do that here in a minute. We're going to take a look at past forecasts and talk about when and why investors should respond to them. We're also going to look at many of the variables that impact financial markets today, what your financial plans might include for the coming year. You know, the rate of change and the rate of information coming at us is not slowing down. So it might be a good chance to step back and go, hey, what about all this noise and what of it should I be paying attention to, if anything at all? As always, if you have any questions or would like to meet with a Foster Group advisor, please contact us. Our team's fully engaged every day. We're happy to meet in person. Technology continues to allow for face-to-face conversations as well if you don't feel comfortable coming into an office situation, particularly in light of the current virus situation. We'd love to talk with any of you about your financial goals, financial plans, your investment portfolio. Please feel free to contact us at your convenience. Also, we want to be addressing your questions this year. So if there are specific topics you'd like us to talk about, you can email that information to us at the contact information that you see on your screen right now. We look forward to continuing to providing these bi-monthly financial perspectives reviews, and we're going to see you in weeks to come. So we hope you'll join us next week when we talk about forecasts. We also hope to see you on future versions and editions of Financial Perspectives. Thanks for watching.